everyone, and welcome to Mish's Market Minute. I am your host, Mish Schneider, and this is the weekly segment from StockCharts TV. Well, it sure has been one heck of a week with the Powell rally on the day of the FOMC of 900 points, followed by a 1,000-point drop the following day when everybody came to their senses and realized that not only was he not really fighting inflation, but it wasn't quite as dovish as they thought. And low rates really won't help this market. So what I wanted to do today was give you a good macro sense and a roadmap, because there's a lot of hyperbole out there where you're going to hear people say, buy this dip, market's going right back up, and you're going to hear people saying we're going to crash. We think we're in a trading range, albeit volatile. And so as a result, I want to give you a really good idea so that by the end of the session, you can walk away with a sensible, smart plan that reduces risk and perhaps gives you an ability to make some money on the pops.
So I'm calling this segment a roadmap in a volatile trading range market. And I'd like to start by showing you the last time we had a stagflation trading range market was through the period of 1966 to 1982. And then from there, we're going to cover the indices, some of the outliers that I always like to talk about, including commodities, and then the key sectors. So let's get going. So I love this chart because this chart shows you that passive investing in these sort of periods of time can really give you zero or even negative returns on your money. So what this shows is the period of time between 1966 and 1982, before the market started taking off, looking at it through the Dow. And if you look at this 100 line here, this is $100. So basically what it's showing you is that if you put $100 in, let's say in 1966, you saw a little bit of a return, not until like 1973. So that's like 7 years right there before you saw any kind of return. And look at the return. You've got a 20% return because you got 120. But if you didn't get out there, that quickly went into a negative return of 40% because the market dropped in 74. And it really wasn't until here in 1982 where that $100 actually started to make you some money. And I'm showing you this chart because this also, when we look at the Dow Jones at that time, and I'm not going to show you that chart right now, there was a 40% move from the high to the low. Adjusted for inflation and looking at the SPY, we've actually had about a 40% move, which means not necessarily that we can't get lower. Of course we can, but that these peaks and valleys that we're seeing, is particularly these big scary drops like the one we're having the day I'm recording, can be met as the bottom of a trading range, and we could continue to chop around. So in this case, you saw lower lows, and so far this year we're seeing lower lows, and we'll look at that when we look at the SPY chart. But at the same time, once that low was established and we whooshed out, we really basically every time we hit this level, you can see we got a rally, not such a great rally, and they got shallower and shallower for years, but eventually we took out the that whole point. And I'm not going to say 15 years because that's insane. Everything moves a lot faster now than it used to. But I am predicting that we could be in a trading range. So get ready until 2024, 2025. A, will be in a new regime in terms of president. B is hopefully the Ukraine-Russia situation will work itself out. C is that hopefully inflation will also adjust down. And D is that we will be the end, if those of you who believe in the Chinese New Year's, will be the end of the period of where the element has been water, and we will go back to an element of fire. Generally, the Chinese believe that that's when prosperity really hits. All right, let's go to the charts. Okay, so let's start with NASDAQ. So NASDAQ, when I talk about the lower lows, like we just saw in that chart from 1966, certainly you can see here that we're making lower lows. Here's the first move down in January, the next move down in February, the next move down in March, the next move down in May 2nd, and we haven't quite gotten there. If we can continue to make lower lows, obviously we're going to be in for more pain. But if we do kind of what we just showed you is possible during that period of time, only in a much more narrow period of time, say over the next year or so, then this could be, and I'm not saying it is, but it could be the low. And if it is the low, what did we see? We saw the rallies get initially bigger because it was such a great oversold dead cat bounce type of rally, kind of like what we saw yesterday. But it could be that we just get choppier and choppier and narrower in terms of our trading range. That makes it really hard to make money, at least in the growth stocks, which is why I've been telling people, if you are in your later 60s, 70s, or beyond, get out of these growth stocks. Should have had already. If you're young and you want to try buy down here and you don't mind having no return on your money because maybe in 5-10 years it'll start to grow again, especially in the tech stocks, then by all means, but just be wary of the fact that you're not going to necessarily get returns for quite some time. If you're more like the audience of StockCharts and active trader, then you're really going to have to find your opportunities elsewhere in the sectors that are outperforming rather than the ones that are underperforming. So I'd stay away from NASDAQ stocks, at least for the time being. Now, if we go to the SPY chart, we are also not necessarily seeing the same pattern of lower lows, but we are seeing a lower low than the one, say, we had in February with the one that we had just most recently at the beginning of May. And again, we haven't quite gotten down that far. Can we? Of course. But what we have right now was some kind of a mean reversion trade. You can see right here where it cleared on the Bollinger Band and then cleared in the price. And now we're coming back to test that. So I would say that we could get back down to maybe 405, 406. If we don't break it, and I wouldn't necessarily buy the falling knife, but if we don't break it, and we start to see a little bit of firming action in the price and the selling dry up, there's one of your opportunities, but you better be thinking very actively in that situation. And of course, if we break down under that 405, then we've got to go back and look at some history here. And the last time we were really trading in those levels was here as we were in 2021 on our way up, and of course, definitely in 2020. So you'll have to go back and look historically at some of those price levels to find support. Of course, you know, for me, I'm looking still at 380. In IWM, this to me is such a key, not just because we also have made lower lows over the course of, here we go, back in January, back in February, now here we are in May. But if we're really going to see any type of situation, and by the way, I need to change this one thing. So you're going to see with leadership, it went back to, oh, that's real motion. Sorry, hold on. In the leadership chart, it went back to comparing itself to itself. So we're going to actually put in the SPY as our benchmark. So one of the things we really want to be able to see when it comes to IWM is, first of all, a sustained leadership over the SPY. It's already obviously outperforming the Qs, because that's going to be a sign that maybe we're going to start to see some level of growth in the economy. Right now, that's been tough to really fathom. And again, in this trading range, so far, we've held around this 180 level. If we break this and you look at a weekly chart, 176 is where the 200-week moving average comes in. But you can see that even though it looks choppy as heck, we are in a trading range from 211 to 180. And that range I would expect to get tighter and tighter, just like I showed you when we looked at that 1966 chart. And just to finish up the indices, of course, let's look at the Dow. The Dow also, in this case, does not have lower lows. It did here, but we've so far had this low right here, which means if we break down under this 324 in the Dow, that could also be a bad sign for going lower. And you can see right here that it's still well outperforming the Dow, excuse me, the SPY, but again, having really kind of horrible momentum. And one stock that's in the Dow that's actually been relatively outperforming has been IBM. So that might be a place to look on any strength for a small position, or at least to catch some kind of a rally. Now let's go over to the real issues here, which is these outliers. So here's our TLTs. I mean, just horrible. And of course, when you have this type of move in TLTs and the yields are going up, growth stocks are certainly not going to be able to perform. And at some point, even though it's already started, it's going to get worse where it hits the consumer in the housing market and in anything that you have to buy where you have to borrow money. The dollar is actually very strong. So if you can pay for something in cash, you don't have to deal with the interest rates. But of course, the price of everything has gone up and the dollar has gone up. So that's been the one advantage. But if we go back historically, I'm looking at about 111, 112, maybe as the place where we start to see a little bit of a reprieve. And now the junk bonds, you know, those of you who follow me on Twitter know that this happens to me, my absolute favorite place to look, high yield, high debt. And if we look at this right now, we had a mean reversion trade here. And now we're not quite breaking down under the Bollinger Band here. We touched the price below and we're sitting right there. So once again, if this can hold up these lows that we had the other day, and it was a nice reversal with some decent volume, then perhaps again we'll be in this sort of tradable range. If it breaks though, I think this too can go down further. That will affect the whole market. And I see this going next to about 94 if it breaks. If it can hold, that would be really, really good. Now I wanted to look at VIXY too, because what's interesting about VIXY is that you would think with this type of action that we've seen in the overall market, that this would be trading up here somewhere, up like where we were in this area of time, which was back in 2021. But no, it's actually still, it's above the 50 and above the 200 today. But at the same time, it's not even at the peak, even though the price is close, that we saw here on this day, which was May 2nd, when we saw that low. So volatility is following with the market going down, but still showing a level of complacency. When I looked at the weekly chart in VIXY, I said a weekly close over 2065 could mean another move lower is coming. Now let's move to gold. Gold has been something that I really am still thinking has completely underperformed the SPY relative to what it could do. And yet here you can see it's coming back above it. The Bollinger Band is sort of held critically and had a mean reversion trade as well. But today with the market selling off, this too sold off. So basically what we're looking at right now is if we don't break down further, let's say we hold around this 175. I didn't buy it here. I bought the DBC instead based on the oil and on the gold movement, which is about 20%. But I'd like to see this get back, maybe back over 175.60, 175.80. And then I think you would have a pretty decent risk down to the 200 if you want to sit with a position. This is one position that I still believe could go higher. And of course, oil, you had an OPEC meeting, OPEC plus meeting, and they haven't really said that they were going to raise the production too much. And oil's still pretty high. And of course, very prone to the geopolitics of the Russia-Ukraine. But you can see that the momentum has slots off while the price is finding this resistance up here over this 82.50 level. So for now, what we can do is keep an eye on this. Obviously, you want to see it hold the 50-day moving average. And I believe after this big, nasty reversal bar here, if we can get back over these levels of 82, then maybe we're going to see another leg up in oil. That's not going to be good for the market. And if we move over to DBA, which is really wheat, which is super strong, corn, which is strong, soybeans, which are strong, but also has the element of sugar and coffee in there, which is why it's not so necessarily following up the way it is in the grains, is holding yet nonetheless the 50-day moving average. And I think the grains are still in a situation where they can go higher, not necessarily the softs as much, but definitely the grains, because in the United States, we still have a wet period. We can go from a wet period to an incredible drought period. And of course, we know the Ukraine is still definitely not able to produce food. And people all over the world right now are finding food shortages, which of course can then lead to a rise in gold prices because you get unrest when people can't get food on their tables. Here's that DBC I was telling you about. So right now we want to see this hold really basically 27.50. Again, it got right up to resistance and came off a little bit. Momentum is also slot off, but if you start to see oil go up, this thing is going to continue up as well. Now let's move to the sectors. So we've got retail. Now, granny retail, obviously consumer discretionary. I don't know, some of you saw Etsy reported poorly, but we have had at least some quasi double bottom here at around the 69.70, 69.90 level. That's great because that gives you a point. If we can get back in momentum a little bit and hold here in the outperformance against the SPY, then perhaps this is a tradable low as well. Would I run in on a Friday when you're going to hear this ahead of a weekend? No. But would I be more encouraged that this thing can get back and hold over 70? Yeah, that would also tell me everything I just mentioned to you. Don't be as scared because we could have just found another test of that tradable low in the overall market. Of course, IYT has just been sloppy as all heck. This too is showing leadership still though over the SPY. And momentum, though, not so great. But once again, we've had a couple of lows here in this area between 236 and 238. So we'd like to see that hold up as well. Now, again, I have to keep saying this over and over and over again, so I'm not misinterpreted. That doesn't mean that I think this is a low that's going to be the great buy opportunity and the market's going to go higher again. I'm saying this is the tradable low within a trading range that might get narrower, making it more difficult to actually make money. But nonetheless, for the time being, it gives the active traders an opportunity to adjust accordingly. Now let's go to IBB. This was the great disappointment because I really thought that pharmaceuticals might hang in there better, but we did make a new low recently here. We've popped since and now just getting an inside day as I'm talking to you. So once again, maybe some relative strength. What I would look for, what would actually make me a buyer potentially of IBB again would be, first of all, a move over the 50-day moving average on the real motion indicator. 2 would be some kind of a leadership over the SPY, which means this blue line would have to cross over the red line. And 3, probably at this point, we have a neutral slope, one of the few in the 50-day moving average, and that's because this thing has been in a negative range or a bear phase for quite some time, would be 2 crossings and closes over this 50-day moving average. Then I would say IBB may be the first place to go. And by the way, in 2008, 2009, after the crash, IBB was the first instrument of the sectors that I follow that bottomed out. And it actually bottomed out at 100. When you think about that, from 100, it went all the way up. At one point, it was trading much higher. I think the peak of this whole move up was like 170. And now here we are at 117. So we're still in better shape than we were in 2008. That's why I think that maybe this would be, once again, the first one to give us a sign. KRE, regional banks, also tried to bottom here, also outperforming the SPY, also going down in momentum. Wouldn't be the first place I go, but nonetheless, it is holding this low. So like everything else, if it got maybe back through 65, perhaps it could be interesting, but we just went into a death cross here. So I wouldn't anticipate very much of a movement up. So you'd really have to watch your risk reward. And that's another note, by the way, is you have to watch your risk reward when it comes to these things, because if you're going to be looking for moves that are shallow, you have to make sure that you don't risk more than you're willing to make, because then all of a sudden you're really, really in a bad situation with a 1-to-1 or less type of risk reward. So you got to have tight stops if you're going to trade more actively, and get out if you get more like a 2-to-1, or at least go to a no loss stop. Bitcoin really is breaking down here, which is a shame. So it broke down under 37,000. If it continues to break down and hold under that 37,000 and doesn't come right back through it, let's say tomorrow at the end of the week, then we're looking at a move maybe down to about 33,000 as the next place to look for support. This has turned out to be the great decoupling, is that it was sort of on par performing with the SPY. Now it's actually slightly underperforming. So Bitcoin is definitely not a great place to be going right now. Now, if we look at real estate, with REITs and mortgage rates going up, obviously that's going to be an impact. But what is also interesting about real estate is that your moving averages started moving closer together, which means a golden cross with the price down here would certainly be interesting. We'd need to see better momentum, of course. But the housing market, depending on where you are, is still really strong. The housing prices have gone up. Maybe the number of houses being sold have gone down, but we haven't seen it reflect in the actual pricing of the houses. So I would keep my eye here to more for the macro trend, because people are saying that if we're going into recession, you're going to see it really hit here. And so far, I'm not seeing any evidence of a recession. Stagflation, I'm sticking to that narrative. And also the labor market, which we have over 11 million jobs still unfilled. Now let's go to staples. This was the big place to be, obviously, this year. And now it's come off with the rest of the market, had such a perfect reversal, mean reversion pattern up here. It was like textbook perfect. So now where are we at? You can see that we are breaking down a little bit here in terms of the moving averages on the momentum. We're nowhere near the Bollinger Band. We've held it in price. We're getting an inside day. We still have a strong upward momentum here. I would want to give a little bit more evidence to see if this thing actually plans on holding 76. I'd get out if it doesn't. But if it holds 76 and say gets back through 78.50, you might have another opportunity, as consumer staples should continue to do well. Obviously, in a liquidity crunch, everything underperforms. And the last one that also has had relative strength, although has come off because it's interest rate sensitive, is utilities. And we're getting an inside day right under a positively sloped 50-day moving average. It's going back to outperforming the SPY after this big sell-off. It's still on momentum, holding the 200. Like to see it clear the 50 here. And let's just say that. Let's see if we can get two closes back over this 50-day moving average. And if that's the case, I would have a relatively tight stop. That means clearing over 72.50, I wouldn't risk more than like $1 in this, because it would be realistic to say that you can get $2, maybe $3, but that's about it. And more importantly, if the utilities actually can hang in there, it might be a sign that things got a little bit overdone in terms of the yield curve and the rising rates.
Well, I hope you guys really stay safe during this. Remember, if you find yourselves very confused, cash is something that you can have at the moment. If you are learning to trade at this particular time, when the market is so difficult, I say congratulations, because the best time to learn is when the market is difficult, because when the market gets easy again, you will really have the confidence to push it. Thanks so much for watching, and bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.